Hi, Scott, and I'm very happy to have you here on my podcast. You have more than 35 years of experience in wealth management, it's called now, and I'd like to hear your story. So when you were 32, you took over your father's firm management and grew AUM several times, probably from 300 million to about 1 billion in assets under management. And I'd like to hear your story, how you started, and then maybe like what were your main periods in your career where you got some insights, maybe moved to another thing, and like where you stand now. So would like to hear your story, please.
Sure thing. Thanks, Matt. Yeah, well, you're right. Coming out of college, I actually didn't go to work right away for my father because, well, he had a rule that I had to work somewhere else 3 years first. And when I graduated, actually my first job was selling advertising for a rock and roll radio station in Detroit, Michigan. And I did that for 3 years. Kind of got that out of my system. It was more of an extension of college, I think, than it was a real job. But yeah, I did return to my hometown in Cleveland, Ohio in 1990 and joined what was then Roulston and Company. Started by my father, Tom Roulston, in the 1960s. And Roulston and Company at that time in the 1990 period had two businesses. The principal business was investment research across a universe of roughly 220 publicly held companies located in the Midwest, the Rust Belt, if you will. So these companies were in manufacturing, automobiles, appliances, steel, tire and rubber. And so those industries indigenous to the Midwest, we had research analysts. We had about 120 people total, and about half of those did nothing but visit companies and find out what they were doing, what was going on, what their strategies were, and eventually what their performance was and how their stock price would perform. And you got to keep in mind that in the 1990s, this was pre-internet. So we actually had two corporate aircraft that we were flying 5 days a week and going to places like Benton Harbor, Michigan, to visit a company like Whirlpool that manufactured appliances. And when we did that, the company's management would tell us things about, well, they'd answer all of our questions regardless of whether other people from New York and Wall Street knew or what have you. So in some ways you might call it inside, by today's standards, insider information or material non-public information. But they would tell us right up until the most recent days or weeks what the company's performance was, because there was no internet and there was no regulation FD until about 1998, 1999, which required simultaneous release of proprietary or confidential information on things like performance of the company. So our clients who were using the research were people like Peter Lynch of Fidelity's Magellan Fund. And he was well known because he had over that 10-year period in the 1990s, I think it was a 29% compound rate of return on his investment portfolio. So we were kind of his eyes and ears in the Midwest and in those industries that I mentioned before. And we also managed money using the same research, but that was kind of a secondary, almost a stepchild business, because our staff would provide this institutional research to big investors like Fidelity. And then, yeah, we can manage your account for your retirement or what have you as well using the same research. So it was almost like 90% was this institutional business and 10% was this, call it retail business. Well, as time went on, commission rates, that was another important part. Commission rates up until 1974 were regulated. It cost over $200 to trade 100 shares of stock. Those rates of trading came way down thanks to Chuck Schwab and Schwab Corporation, where they came out with trades that were, I think it was $69.95 and then $59.95 and all the way down to $9.95 a trade, and these days they don't even charge for a trade. So you had these things changing and evolving. First of all, material non-public information had to be released simultaneously. The internet was there. Commission rates were down. And I kind of looked around one day, and my father and I and our board of advisors, we had an outside independent board. We said, this institutional business is kind of going downhill. It's more competitive. It's more of a level playing field. But this money management business is more attractive because it's recurring revenue. Once you get a client and you're managing their money, you typically charge a fee based on assets under management. And if you do a good job, that will increase over time. So we got out of the business that was our principal source of revenue, which was the majority of our revenue, the research business, to focus on building up what we called money management back then. Nobody called it wealth management, as I recall, in the early 90s, because wealth was somebody who had a bigger house than you did or something. And around 2000, we acquired another money manager, and then we rebranded as Fairport Wealth Management in the early 2000s. And in 2007, we sold what was Fairport Wealth to a private equity-backed roll-up group. And when I say that we sold a controlling interest of our business in 2007, a lot of people say, well, you timed that perfectly right before the great financial crisis of 2008. I wish I was smart enough to have foreseen that, but that wasn't the case. We were more lucky than smart. But 2008 and 2009 was a difficult period for anybody, but especially when our revenue was dependent on how much assets we managed. And when the market went down by 30%, so did our revenue. And our costs didn't go down by 30%. So 08 and 09 were very difficult years for Fairport Wealth. And, we really haven't had a pullback like that in the last 17 or 18 years or so. There will be one at some point. But that was a tough time to be in that business.
And then, what happened next? Where you started participating, maybe on some boards?
I didn't quite see eye to eye with some of the people who we sold the business to, and we parted ways. Fairport Wealth is still around as part of a company called Hightower, doing very well. I worked in the wealth management industry with a couple other companies, one based in Cleveland here, and then I got recruited to Chicago to run wealth management for a firm called Siegel, Bryant & Hamill, which eventually was sold to private equity. And then in 2020, I was fortunate enough to get introduced to the Pritzker organization, which is family office for Tom Pritzker and his immediate family. And the Pritzker organization had developed a thesis to invest directly into the wealth management industry. They saw it as an attractive industry to invest in, but we're looking for somebody who had worked in the business before, who had a network of contacts, who understood some of the nuances in the industry. So, and the Pritzker organization has a bunch of very professional investment experts, and they're used to direct investing, buy and hold forever, if you will. And we can talk a little bit more about the history of Pritzker and family offices. But that was a new twist for me, working with an organization that had such a long-term outlook, multi-generational, that it's a different investment thesis than working with retail investors, individuals and families who are really just focused on how are we going to live through our retirement, how much can we pass along to our kids, and those sorts of things.
Yeah.
And family offices have been proliferating over the last few years tremendously.
Is it, talking about the Pritzker organization, is it the only thesis they invest and focused on now, or they have a portfolio of real estate, private equity, maybe venture capital and other assets and public markets? So I just try to understand the strategy of, let's call it GP stakes and wealth management firms.
Sure.
How much of the portfolio is this strategy?
Sure. So, I think anybody who's worked within the family office space would probably tell you the joke is if you've seen one family office, you've seen one family office. They're all. There are similarities sometimes, but there are usually more differences than there are similarities for a lot of reasons. In the case of the Pritzker organization, it was started in the post-war era by Jay Pritzker. And Jay was known for direct investing. Probably the brand name that people are most familiar with is the Hyatt hotel chain, which he started with one hotel at Los Angeles LAX airport. And Jay built an empire by direct investing in privately held companies. In other words, the real thesis was find a good private company with a great management team, with a good strategy, and do everything you can to support them, provide capital to them, and help them grow. It's really about the miracle of compounding tax-free. If you have a great company and a great investment, why would you want to watch it grow, sell it, pay the capital gains tax on it, and then try and replicate that all over again? So it's an approach kind of like a Warren Buffett and Berkshire Hathaway or others. So as Hyatt was well known, as I understand it, I did not know Jay Pritzker. I know and work for his son Tom. But the Pritzker organization wasn't even the biggest one. It was probably the best known company. The biggest one was a company called Marmon Industries. But there were dozens and dozens of other companies that the Pritzker organization made direct investments in. So what's different about family office capital versus, say, private equity capital is typically when people invest through private equity, it is defined in the contract between the sponsor and the investor. Okay, we are going to raise capital during this period of time, then we are going to invest that in companies in a subsequent period of time. And then it's defined specifically at some point when those investments will be liquidated and when the sponsor is going to return the capital to the investors. So there's kind of a use-by date there that is embedded in the relationship between the sponsor firm or individual and the investors. Family offices don't have to operate under those ground rules. And they have different things to consider. Family governance, taxes, cash flow, all of those kinds of things become issues for family offices. But I think one of the driving forces here is that if you think about the miracle of compounding tax-free, and you really don't have to have access to that capital with any certain period of time. In other words, there's capital that can be forever capital. Direct investing in private companies can be a much more attractive kind of investment than either trying to beat the market or to invest in mutual funds or those kinds of things which pretty much mirror the returns that you get by investing in the public equity markets. So, in other words, there can be some more inefficiency in direct investing in private companies because you know some things that other people don't.
Yeah, but talking about this strategy of investing in wealth management companies of the Pritzker organization, is it the only strategy now, or you also invest in different types of companies and in different types of, I don't know, real estate and others? So I try to understand what is the portfolio construction for such a family office.
Well, to be clear, the Pritzker organization, as most family offices do, invest in a variety of industries. I mean, they have businesses that are in insurance, in all kinds of different categories. The wealth management space, they were particularly interested in and excited about because they foresaw the consolidation of the industry. And the industry, well, wealth management has really been a very fragmented business up until just the last few years. There are thousands and thousands of wealth advisors across the country. It pretty much started out with the big wirehouses. They got their name Wirehouses because they had a direct wire to the New York Stock Exchange or the American Stock Exchange. But those wirehouses have really evolved and changed over time. Most of them have been bought by big banks like Wells Fargo, and then you've had a lot of individuals get into the wealth management business because there's not really many barriers to entry into the business. So there are literally thousands and thousands of registered investment advisors and investment brokers, although the number of brokers compared to wealth advisors has shifted more towards wealth advice and the fiduciary responsibility. We can talk about that and governance. But I think the Pritzker organization correctly spotted the opportunity to gain efficiency and grow these businesses so long as they had really good management. They had a strategy that was differentiated. And in the case of Pritzker, I think you look back on the investments that we've made, they have been in companies that have been somewhat unique in their character. We can talk more about who those companies are. Mm-hmm. But Pritzker, like other family offices, usually have different niche industries where they spend some time studying what's going on in that industry and coming to a decision as to whether they want to invest in that industry, and if so, how.
And let's talk about different types of organizations working in wealth management. So there are like multi-family offices, there are registered investment advisors, broker-dealers. What are the differences between the business models, and what are the differences for customers if someone wants to invest? Like what they should look for in different types of supporting organizations in wealth management?
Sure.
So,
Sure. Well, like I said, if you went back into the 1980s and 1990s, the predominant business model was the broker-dealers. And typically, the investment decision was left up to the individual whose money was at the broker-dealer. And the broker would call the client and say, I have an idea for an investment. And the client would say thumbs up or thumbs down on that idea, and how many shares are we going to... And the broker made their money on that transaction. Then with the regulations changing, the RIA, or Registered Investment Advisor industry, started proliferating in the late 80s and 90s. And the big difference between a registered investment advisor and a broker-dealer is, with a broker-dealer, because the client has so much authority, it's kind of buyer beware. With a registered investment advisor, that advisor must be licensed, number one, so they have to have some sort of training and background and education and understand what the ground rules are. And they have a fiduciary duty. As we keep seeing on advertising on television all the time, we now know what a fiduciary duty means. Thanks to all the advertising that some firms have been doing. And that fiduciary duty has a standard of care that the investment has to be suitable for the client. In other words, you shouldn't be putting your clients who, let's say, are older, into an investment that may take a long time to mature and get a return on. So, in other words, older people shouldn't be investing in very long-term investments because they don't have that kind of a time span and an outlook. I think over time, that model, that fiduciary duty has become, and the fact that the money manager is not getting paid based on how many trades they do. So they aren't incented to churn that account and do lots of trades. Instead, the advisor is compensated by how the assets, what the assets are worth. So if the assets appreciate, the client makes more and the advisor makes more. And that assets under management model has been becoming more and more popular over time. And the RIA model has grown and grown. However, the dilemma has been, as that industry really started to grow in the 1990s and early 2000s, you had a lot of people enter that industry, and now, like me, they're all older and trying to figure out, how am I going to sell this business? Because it's really, or how am I going to monetize this business that I've grown? Because I've developed all these client relationships, because I've acquired all these assets to manage. But now I've come to a point where I'm thinking about retiring. And who's going to be able to come along and pay for my business? Enter private equity to solve the problem and consolidate and even take it one step further and try and get some efficiency in the industry, in the company, and scale. So private equity, family offices, large banks, even sovereign wealth funds have been investing in the RIA space, and we've seen a tremendous consolidation in the space over the last few years.
What is typical fees? What are typical fees? Is it 220 or is it lower for registered investment advisors? How does it work? And whether there is a difference between RIAs and multifamily offices?
Yeah, great question. So the 2 and 20 that you're talking about is typically kind of code words for how private equity shops work. Typically, private equity will raise capital from an investor. If I'm the private equity sponsor and you're the client, I say, here, come invest with us. We have a minimum of so much. You must be a qualified investor. In other words, you must be on the wealthier side. This isn't your life savings and you're going to put it all into this more risky investment. But we're going to charge you 2% annual and 20% of the profits when we sell the business. That is the typical structure of private equity. Now, it may be a much lower fee than the one I just quoted for a large institutional client, like a pension fund, or like a, well, we talked about some of the large pension funds I've been involved in, you know, such as government pensions for public employees and so forth. They wouldn't pay 2 and 20, they'd get a discounted rate from that. On the other hand, registered investment advisors typically start with, for most folks who have, let's say, $500,000 or $1 million, they would start with a fee that is 1% of the first fill in the blank, 1% of the first 2 million, maybe 0.8% on the next 2 million, and so on and so forth on a sliding scale downward. But even that is changing right now. There is no norm. There is no set way. Firms have to be public about how much they charge in a form that they file with the Security and Exchange Commission called a Form ADV. If any client is hiring a wealth advisor, they should probably ask for a copy of that ADV, or they can go search for it online. But yeah, the percent of assets under management has been the most popular structure. I think that's going to change. In fact, I'm working with some companies right now that have changed and have a different model and are paying more or charging more of a retainer fee. And the retainer fee is based on not just the level of the assets, because a lot of the things that especially higher net worth or ultra high net worth, people who have 10 million or 100 million, they're looking for more than just investment advice. They're looking for tax assistance and advice, perhaps bill pay, and that's where family offices or family office services come into play. So family offices can do much more very often than just manage the money. And we can talk a little bit more about how family offices are evolving, but you're hearing more and more about family offices because there's been so much wealth created, especially over the last 15, 20 years as the market has just continued to appreciate, and we haven't had anything like the great financial crisis of 2008.
So do I understand correctly that registered investment advisors don't charge carry typically and only charge either retainers or some percentage on capitals they manage? or they also use carry as their fee, so profits from the investments they make.
Yeah, well, if we're talking about the family office space in general, it's typically started out as single-family offices. We talked earlier about, I've worked with the Pritzker organization, which is a single-family office for Tom Pritzker and his immediate family. The other members of the Pritzker family, descendants of Jay Pritzker, some have their own family offices. So here's one family, if you think about it, and it started out with one family office, but now as time has passed, other family offices for different family members who have different goals perhaps than their siblings or their relatives, they go off on their own way. So, and I think the other thing is that with all the wealth that's been created, entrepreneurs who start these businesses and come to a point where maybe their heirs, their family members, their sons and daughters aren't interested in working in the business that their father or mother started. And then the question comes up, should the family be selling that business and moving on, or should they continue to own that business and hopefully it'll keep growing and compounding without paying taxes?
Here I try to understand about the fees structures of registered investment advisors. So whether it's just retainer or percentage, like management fee on the amount of capital. So you mentioned that they can start with 1% and then lower the amount,
Right.
0.8 for example. Or they also charge carry like private equity funds.
Right.
Yeah. So like just trying to understand what is the benchmark on fees of registered investment advisor.
So I work with one company right now that's a multifamily office. And so they work for dozens of families, excuse me. And the management of that company said, you know, even though the norm has been to charge on a assets under management fee base, we're not going to do that anymore for ultra high net worth families. And the reason is because if that ultra high net worth family, let's say it's a family that's worth 100 million or 200 million, chances are that they own maybe not one, but several businesses. And maybe they don't have just one home, they have several pieces of real estate. So if a family that's that large that they have these multiple businesses or multiple properties or both, what happens when they sell a piece of real estate or they sell a business? Very often that goes to the wealth advisor or the multifamily office. And that multifamily office isn't doing any additional work. If they managed 50 million before and now it's 60 million, they're not really doing any more work. So why should the client pay more to have a modest, relatively speaking, more amount under management? That's where the retainer basis is starting to come in as a model for multifamily offices or even single-family offices who have employees, direct employees, and it stays pretty static in terms of what the fees are in the single-family and multifamily office space. Does that help?
But yeah. And does this firm charge also carry or success fee on the like profits from the investments they make?
Rarely. Rarely is that done. And I think while the carried interest model probably makes sense for either early stage venture capital or later stage buyout type firms. In generally speaking, the wealth management, multifamily office space, the carried interest is probably not going to be a model that clients are going to flock to.
Okay, yeah, for me it's interesting because it seems that like obvious way to align interests and incentives of both advisor and client. But yeah, it's interesting. Maybe, yeah.
Look, it would be really dependent also upon whether the family, the owners of that wealth, whether they are hiring their own people in their family office that is dedicated to that family, or whether it's a multifamily office where they're doing it maybe for dozens and dozens of different families. So it really depends on it's become more complex than it used to as the multifamily office model has continued to grow. In fact, I would make the argument, Max, that over time the bar is going up where it doesn't make sense for a lot of these families to have a single family office, because finding the right employees, the employees who are working at a family office, they have multiple things where they need to be somewhat experienced and have some knowledge and expertise. It's not just investments. In fact, taxes can be much more important than investments and cash flow. Bill pay. Bill pay is a very popular service for wealthy families. Who likes to pay bills? And so you hire somebody to do your bill pay. So in some family offices or multifamily offices even get into things like family governance. They get into things like counseling. They even get into things like healthcare and concierge services around healthcare. Many families are wealthy enough to have their own private aircraft. And even scheduling those kinds of things becomes an administrative function that the family members would rather hire somebody to take care of rather than to do it themselves.
Yeah, great. Then let's talk about how wealth management firms are valued. So what multiples are used? Is it based on EBITDA, revenue, or AUM, or like what is the benchmark you see now?
That's an excellent question. When I sold Fairport Wealth, which we talked about at the very beginning of our conversation, we sold it on a sliding scale at about 8 to 9 times our profitability. We thought that was a pretty high multiple back then. Today, some of these firms that have tremendous scale and have lots of assets under management, and they're dropping a lot of that down to the bottom line, and also if they have good organic growth. And I think that's really one of the key measures. I mean, a firm can have 10% growth, or they can have 2% growth. If all their growth is just in how the market goes up, then it's probably not going to be valued as high as a company that's constantly bringing in new clients. So the multiples can go anywhere from 1 or 2 times profitability, or even 1 or 2 times revenue, on up to 15 plus times. It's gotten way more expanded over the last 10 or 15 years. Why is that? Because it's been a fairly stable business in terms of recurring revenue. Once you land a client, rarely do they change wealth advisors. It's kind of a pain in the neck to do that. So it's sticky in terms of the relationship between the advisor and the client. But with some of these advisors, and the average age of an advisor has gone up and up and up over the last several years to where it's approaching 55 or 60 years old. And if there isn't any succession plan in place, then it's pretty likely that if that firm is trying to sell itself and bring in new capital, they're going to have a tough time doing it, because from a client perspective, you don't know who's going to be managing your money. And all that trust and relationship that's built up over time really isn't valued very highly.
Yeah, so and the revenue typically, if I understand correctly, if we can compare it to assets under management, is just less than 2%. It might be 1% or 2%, or they have other sources of revenue. I mean, registered investment advisors have other sources of revenue, not only some small retainer or management fee from the customer, or maybe they provide some additional services. So how does the revenue typically appear in such a registered investment advisor firm? What are different types of revenue for such companies?
Well, I think most registered investment advisors are charging an advisory fee based on assets under management. So I think that will still be the predominant business model that firms will have for the foreseeable future. But let's wait and see, because it's been, like I said before, 18 years since the great financial crisis. And I think some of these firms are going to look at that fee model and say, do we really want to set ourselves up for being tied to the market? Because we lose some control over our destiny that way. So, but time will tell. And for right now, the assets under management model is still by far the predominant model in the wealth management industry.
Okay, understood. Yeah, then so let's talk about the GP stakes strategy and the deal. So the Pritzker organization invested $100 million in Steward Partners in 2021, and this is probably one of the examples of a successful registered investment advisor who grew substantially. I think they're quite young firm, but still continue to grow. And at the time of the deal, they had $20 billion in assets under management in 2021, and then grew to $50 billion in assets under management just in 4 years. So the question here is, how did you evaluate this deal? So if I understood correctly, you participated in the decision making on this deal, and if you could share a bit insights on what made Steward attractive for the Pritzker organization, would be great to understand.
Sure. Well, I'll reference information that's already public that is out there, but make it easy on your listeners, your viewers, so they don't have to go dig it up. When we embarked on this journey, when I joined the Pritzker organization to advise them on investing in the wealth management space, if you had asked, we would have probably thought we would invest in a typical wealth advisor that charges on assets under management, like we've been talking about for the last few minutes. But we were introduced to the Steward Partners along the way. And Steward Partners has a unique model because they've looked at what is called the wirehouse model, those big firms that used to be brokerage firms or are still brokerage firms. And a lot of those firms don't really have any way for the advisor to monetize the book of business that they've built up over a lifetime, over a career. And so if that advisor has built up a book of clients and business and revenue, and they want to retire, is there any way that they can sell their business and monetize that? And Steward came up with a model where they will bring on board advisors from the wirehouses who were used to both a fee and a commission kind of compensation structure in their relationship with their client. And many of those had gotten older over time and were thinking about retirement. And Steward would go to them and say, we will pay you for your book of business. And the way that they were going to pay these advisors was a forgivable loan over an 8 to 10 year period. So they would get some money, and that loan would be brought down over a period of time. So Steward found the capital to be able to give them those forgivable loans. And the advisors who joined Steward also got stock in the company, with the idea being, we're not going to fight with each other. We are going to all be on the same team, pulling in the same direction. And there's going to be some collaboration and cooperation amongst the advisors so that we get some efficiency in this business. We're all working with the same kind of systems. We're bringing some uniformity in the consistency of the client experience. That turned out to be a very popular model for the wirehouse advisors to join. And when we first took a look at Steward in 2020, there was also another family office that had invested in Steward Partners. So we like the idea of investing with another family office side by side because they had the same time frame that wasn't, hey, we have to return capital to our investors. It's more like forever long-dated family office capital. And the company is called Sinosure out of Salt Lake City. So we did invest $100 million into Steward Partners, and the management team there has done a fantastic job of recruiting these breakaway brokers from the wirehouses and have grown the company significantly with this model. And it was unique, it was different, and it's been very, very successful to date.
Yeah, so if I understood correctly, it is like private equity buyout, but in a different financial model. So when you give money to those advisors, which they potentially could earn in 8-10 years, but you give it now, and then like you collect the payments from their customers, and you integrate their practice into a bigger firm. So it's like a yeah, understood.
You're quite correct there, and that's a very perceptive comment, because to us, the most important factor was the alignment that the different investors had in the company, and I'm including the employee investors too, because if you have in the ownership of a business, whether it's wealth management or anything else, and you have some investors who say, after 8 to 10 years, we're going to sell out and give the money back to our investors. And you have others that say, no, 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 no. We don't want to sell out. We don't want to sell out in 5 years or 8 to 10 years, or we want this to be owned by our children and our grandchildren. That creates some alignment with the employees, and it's also alignment of the different investors in the company. And I think that's one of the things right now. You're seeing a lot of short duration capital investors, private equity, that's going into wealth management and other industries as well. And then you have family offices who are thinking more long dated. Hey, let's buy and hold. Let's compound without paying taxes on the way. So the miracle of compounding tax free. And I think you're going to continue to see more and more family offices or multifamily offices making these kinds of direct investments, because compounding tax-free is better than buying, flipping something, paying the capital gains, and then going and trying to replicate it all over again.
Yeah. So it similar to me to the roll-up strategy in private equity. That's like you pull all the companies or clients together in one entity. And it's interesting for me to understand what is a typical one warehouse or investment advisor who makes the deal. So how many customers do they have? How many assets under management do they have? Is it in the range of 50 to 100 million assets under management for one customer?
You mean companies that a private equity would invest in? Well, yeah. I mean, the first thing is that private equity, does have different. Private equity sponsors have different timelines, but I call it shot clock capital, because usually they have to state in the agreement how long until they sell the business or sell their part of the business
but here I'm talking about so when Steward Partners make a deal with each individual investment advisor who already thinks about retirement. So like what is a typical like ICP of their partner? So how much capital do they manage under management, each individual advisor which is interested in partnering with Steward Partner? And yeah.
Oh, that's a wide range. A wide range.
So
and
minimum, maximum on average. So just.
Well, yeah. Some advisors work pretty much alone, and others work with teams, where different members of the team have different specialty. We talked, about before. It may be investments. It may be taxes and cash flow. There could be a lot of other kinds of services that are provided. So it's a whole range. There is no one kind of cookie cutter, but I think it is. They do very often. Advisors are leaving for a certain reason, and historically, I want to be careful how I say this, but historically, proprietary product, in other words, funds and other kinds of investments that are managed internally, as opposed to using outside independent managers. Let me put it this way. Advisors don't like being told what they have to put into their client accounts. And historically, that's been a real sore spot for a lot of advisors. If they are told or it is inferred that they should go with this investment rather than that investment by somebody higher up in the organization, sometimes that doesn't sit very well.
Yeah.
And different organizations can do that trying to tip the scale one way or the other in a variety of ways. They can incent the advisor. We're going to pay you more if you put clients in this kind of investment than if you put them in that type of investment. I think more and more advisors are saying, you know, if I want to sleep better tonight, if I want to feel that I'm doing the right thing for my clients, I want to be independent in making the decision on what I'm going to put my clients into. And I don't want the big corporation to jam product into my clients' accounts.
So like each advisor has their own conviction on what is better for investments. If they bought into something, then they can advise and sleep well in the night. But if they try to push something, feeling not a great deal for a client, I think they typically don't try not to do like this.
Sure, and I think again we've talked over this entire course. We talked about brokerage and commissions versus fees, wealth management, and having a fiduciary responsibility. And I think as the public gets more educated, as well as the advisors, the public wants to go with an advisor who is independent in the term that they are deciding what is best for the customer rather than being told what they need to put into their clients' accounts.
Yeah, so we discussed one of the most interesting ways on how an asset like a wealth management firm can grow their assets under management by buying other firms. But what might be other ways? So like, what do you think are some other interesting ways on how wealth management firm can grow in size today, not by acquiring other practices?
Well, sure. I mean, if you think about it, I mean, we get bombarded every day by what we were talking before about, the fiduciary relationship. I think until Ken Fisher started buying, and his firm started buying lots and lots and lots of advertising, where they keep pounding the table on, we do what's best for our clients, because we're fiduciaries. After a while, if you've seen that commercial, you're gonna now know what fiduciary means, and all. But in terms of growth of advisors, there's lots and lots of ways that advisors can grow. I mean, search engine optimization and search engine. I mean, there is a very well-known ultra high net worth multifamily office in Chicago that I know that spends, in the neighborhood of $15 or $20 million a year on LinkedIn to promote their business. So companies are getting more and more strategic and looking at how they grow their business. They're not just doing it, by joining a golf club and socializing with high net worth or, friends and family kind of things. Referrals are certainly one method that advisors look for. If you have happy clients, it's not unusual for them to tell their friends or family members. So referrals can be very, very important. Some firms do things like, direct mail, and they have informational sessions, maybe over lunch or a dinner or something like that, where they talk about their firm and what makes them different. But I think the industry in general is getting more and more sophisticated, and they're looking, with a keen eye on return on investment. Like I said, this firm in Chicago that I'm familiar with, who spend over $10 million on advertising. There's a reason that they're doing it. It works, and it works for even on ultra high net worth. I mean, people who are worth more than 50 or $100 million in total net worth. So I think a lot of those stigmas that used to be out there, oh gosh, wealth advisors should be quiet and low key, and the old commercial, when E.F. Hutton talks, people listen. It's taken a variety of ways for this organic growth to appear. One of the ways that firms get better or organic growth is to expand their service model. Maybe getting into those things that their clients really don't want to deal with. I mean, who likes to plan taxes and besides, and pay bills and things like that? So firms are saying, we'll do those things that you don't really want to do. And there are a lot of registered investment advisors, wealth advisors, who are embedded within accounting firms, where the accounting firm will acquire an advisor, and that will be one of the services that they add. So the industry is still in the early stages of going through a lot of change, but the average growth in the RIA space over the last few years has been pretty small. I mean, like 3 to 4% on average. So I think there's a lot of room for registered investment advisors to improve their marketing and business development.
Okay, interesting. And do they typically work with wealthy clients? I don't know. What is the minimum investment they require from a customer? So if you could share a couple of examples, would be great to understand. Like, what is the minimum customer for such RIA?
Yeah, I think that the best firms, let me put it this way. With 3 to 4% average growth in the industry, there's some firms that are growing much faster than that. I mean, where it's double digits, 10, 15%. And there are some firms that aren't even growing at all, especially when you strip out any kind of market appreciation. So there's a whole range there in terms of what is the organic growth rate. I think, especially for the firms that haven't done a very good job of improving their organic growth, they've been the ones very often who have gotten into the strategic growth through mergers and acquisitions.
Yeah.
The other thing, the other key metric in the industry is what the profit margin is. And I think the more successful firms are at least 20% profit margin. In other words, what's the bottom line profit? And a really high functioning firm, their profit margin is probably somewhere around 25 or 30% or more.
Yeah, understood. I'm talking about minimum check size that a client should put into the RIA firm in order to start working with them. So is it 1 million? Is it several million? Or like, what is this minimum customer size for an registered investment advisor?
I think that's actually a very good question, because I think until the last few years, most firms really didn't care whether they didn't really have a minimum or they didn't really have a maximum. They tried being all things to all people. The industry over time has matured and learned, because the needs of somebody who has, let's say, $500,000 or $1 million to have managed by an advisor are going to be much different than somebody who has 10 or 20 million. So I think the smarter firms, the firms that are more profitable and are growing faster, are the ones who have somewhat of a homogeneous profile of what kind of client they do best. In fact, some firms focus on professions. We specialize with doctors, or we specialize with business owners, or what have you. Some firms deal with, they base it on gender, and they specialize in working with women. So I think the better managed companies have some consistency in what their target client looks like. Because if, for example, you get into tax services or bill pay, but only 5% of your clients really need or want that kind of service, you're probably not as profitable as a firm where one client looks like the next, and then the next, and the next.
And are there sometimes institutional customers, or it's only private people, private clients? So are there institutional, I don't know, LPs or some other corporations that decide, okay, we like working with this advisor, and
Sure.
we let them manage some of our money?
Sure. Think of just like we were talking about the family office or multifamily office before. Excuse me. And think about that with institutions as well. Because institutional investors, which could be pension funds, endowments, all kinds of different types, are going to have different needs than individuals and families are going to. So typically, for example, I was a trustee on the Ohio Police and Fire Pension Fund, and I was also a trustee on the State Teachers Retirement System of Ohio. I mean, these are $50 billion, $90 billion pension funds. They have very different ways of operating than a typical family does, because those investments are going to have to pay for the retirement of individuals who might be in their 20s or 30s. And they have processes and rules. They use actuaries to determine not just what are we going to need on the next year or two, what are we going to need 20 years from now or 30 years from now. And so their time perspective on investments is very different than the typical family or individual. And that's why very often the pensions and endowments and all have been attracted to long-dated investments like private equity, because they don't need that money next week or next year. They're going to need it a long time from now. So rare is it that you see the same firms managing money for endowments and foundations and other institutional investors, as well as working with individuals and families.
What are the key differences between investment decision making in a pension fund and in a family office? So if they both think long term, what are the differences in how decisions are made?
Well, I think that individuals and families are really looking that their time horizon is much shorter than foundations and endowments.
Yeah, I mean,
now,
even family offices.
Pardon me?
Even family offices. I mean, like family offices making investment decisions and versus pension funds making investment decisions. What is the difference?
That's an interesting question, because I think that the larger the family in terms of the net worth, the more they act and look like an institutional investor, the more likely they are investing in long-term holdings, whether it be private equity, whether it be early stage venture capital, whether it be real estate, those kinds of long-dated assets where there isn't the liquidity, you can't just exit it, it's going to be different than an individual or a family. I mean, an individual or a family, one day they may need only so much of money to draw out of their account to live, but maybe then somebody has a health issue or something else, and all of a sudden the need for liquidity, the need to pay for expenses and all can change. Pensions, endowments, they behave differently, and large family offices do too.
Okay, so you mentioned earlier that when big institutions invest in, like pension funds, invest in private equity funds, maybe venture capital funds, or I don't know, real estate funds, so they typically get better terms on the management fee.
Yes.
And what is this discount? So let's talk about a typical 220 in private equity. How much the pension fund, which I don't know what is a typical check size, but it's a 90 billion or 100 billion pension fund. Maybe they have a check size of, I don't know, 100 million, 500 million, or what might be the biggest check size they invest.
They aren't going to pay 2% and 20% of the profits. Put it that way. Yeah. Your assumption is quite right.
But
they have some leverage there, and it can really be different too, because if, let's say, a large institutional investor, or a large fund, private equity, or could be a real estate fund or something, of that, they're going to have different terms with each of their investors. And not only that, they will have to have a prospectus. And typically they are going to, in that legal document, the prospectus, they will specify that the client has to understand what they're investing in. Maybe they have to have a minimum net worth requirement that could be well into the millions. So they're looking for sophisticated investors. It's very unlikely that a lot of these types of private equity and it could be private real estate or whatever, very rarely are they going to want older individuals, less sophisticated individuals, people who don't have experience investing in those illiquid investments. It's just a hassle for them not to do it, and it's probably if they aren't careful with it, going to lead to things like litigation and stuff like that. Now, you say, well, isn't there some avenue that maybe these private investments can be more liquid? And there are secondary markets out there that will buy and sell limited partner positions within these private equity funds or venture capital funds and all. But that's a very opaque kind of, usually the seller knows a lot more than the buyer. It's not a level playing field. So the liquidity of these private investments is still something that's very difficult to obtain.
And what is the, I don't know, amount of discount that's typically a huge institutional LP like a pension fund can get? Is it like just no management fee at all, or is it, let's say, 50% discount or 75% discount? So I just try to understand what GPs are ready to get, like how much GPs are ready to provide discounts to get a big
Well, the
LP?
GP doesn't care because the GP has already gotten their money up front or the capital commitment up front. It's the buyer and the seller, and usually the seller knows a lot more about what that investment is than the buyer does. It's not a level playing field. You don't have regulation FD, which we talked about at the top of the podcast, in private equity. And it's kind of like the old joke where if you look around the poker table at who's playing in your poker game and you don't know who the sucker is, you're the sucker. So it's a very inefficient. The secondary market in private capital is very inefficient up until now. There are organizations that are trying to get some transparency and trying to get some liquidity because there is some demand for that. But thus far, it's been really difficult to get the kind of transparency. And so all this wave of individual investors getting into private equity and private real estate and private credit has really grown in the last few years. But I think one could argue, and have a lot of reason to do so, that those markets are perhaps dangerous for a lot of individual investors to try and get in, because the institutional investors really are much better informed, have much more access to information.
Okay. So any direct number on the number of discount for management fee and carry, or it depends?
I think that more and more, having been on investment committees and all with a couple large pension funds and some foundations and endowments, that there's always going to be pushback from clients on the fees, whether it's 2 and 20 or something else. And I think that, and there's a lot of pressure from the constituents. I mean, these large pension funds, when they hear how much private equity firms are getting paid with 2 and 20 kind of fee structures, they're questioning, and rightly so, whether that's really fair. And so yeah, there is no really good answer at what the appropriate fees are, because you do want alignment after all. I mean, you want your private equity firm employees to pick good investments, help nurture, have a clean exit, make a lot of money, and all, and you need talent to be able to do that. But on the other hand, it can be so grossly overcharging that one could make the argument it really isn't fair or appropriate.
Okay, thank you. And do you think that there is a rule of thumb on what is the minimum check size for investments compared to assets under management? For example, like if there is a huge institutional LP investing in some deals, do they look at, 0.1% of the AUM deal check size, or do they look at 1% or half percent? What is the minimum and maximum check size they try to find deals for managing big capital? Yeah,
I think that most private equity firms or early stage venture capital firms or large real estate funds, institutional funds that do major developments and all, it's usually at least $1 million and very often minimums of that are significantly higher than that. I mean, the private capital in general, whether it be private equity, private real estate, what have you, can have a cost associated with it in terms of just legal fees, having a business, tax and accounting fees, and things like that, where you really need scale, as opposed to what some people would call a club deal. And that might be you and me pooling our resources, and I write a check and you write a check, and we're buying a company together, or something like that. But the same thing holds. Usually, these large pension funds and endowments and foundations and so forth, keep in mind, very often they are not taxable entities. They aren't paying tax on the capital gains, whereas the individuals are. So it's unusual to see funds put together where they have both non-taxable entities and taxable individuals in the same bucket. I'm not saying it never happens and all, but you do have those issues to deal with, because whether it's the time horizon, whether it's the tax consequences and all, typically sponsors are looking either to have all non-taxable entities, or they design the fund and its investment philosophy to accommodate taxable investors as well. But it can be such a significant difference that rarely do you find they're just all kind of commingled in the same fund.
Yeah, I'm trying to understand if there is a committee managing 50 billion assets under management in a big endowment or pension fund, what is the check size they're looking for if it's 50 billion? Is it from
usually,
I don't know, 100 million plus, or 500 million plus, or what is the range of check sizes they operate?
Well, I think where you're going with this question is, how much diversification are you looking for? And how much diversification, not only, and diversification can take a number of forms, but diversification can mean either a sector or a type of investment, or it can be on the individual investment. So, for example, if a large institutional is investing in real estate, then foundations, endowments, pension funds, they may have an asset allocation target of a certain percentage. Let's say 10%, we want 10% in real estate. So usually they're looking at different percentage weightings of the different investment categories, depending on what their objectives are. If it's a long-term investor, it's more likely to be in something like real estate, because real estate is long-term cycles, or in, let's say, venture capital, because it can take longer for a venture capital firm to really become profitable and growing. So the time horizon, the diversification, all those factors are taken into consideration. And also, usually the institutional investors, one of the considerations that they have is, how volatile is this part of the market? For example, real estate is viewed as pretty steady kind of environment, whereas early stage venture capital, it can be very much hit or miss. Within 3 years, either the company does pretty well or really well, or it might just completely flop. And so that volatility is equal to how they look at the amount of risk in a category. So typically an institutional investor will want a combination of some higher risk and some lower risk.
Yeah, and probably they might, so if I understand the logics correctly, they might invest in, let's say, several funds of funds in real estate, or just like, let's say, 20 real estate funds, but in terms of venture capital, they need to do many more deals in order to invest in the vintage itself or in several vintages, not just in,
Sure.
in several funds because they like this specific GPs.
Sure.
Is it correct that they typically, so if it's low volatile, you need less number of GPs. If it's highly volatile, you need more GPs and more deals. Like
Sure. I mean, if you just go back and you look at history, I mean, let me put it this way. I mean, like to look at stories and history, and all that. There's a hospital I'm familiar with that put an enormous percentage of their hospital endowment into early stage venture companies in 1999, 2000, when the internet was really coming online. And they ended up having almost 20% of their portfolio invested in Cisco. And then along came the dot-com bubble, and they lost 90% of their endowment within a short period of time. And so, that's what I mean by, the volatility. And right now, I mean, AI seems to be the thing. Maybe that is a great home run, and maybe it doesn't pan out. Time will tell. But we go through these cycles, and whether it's John Bogle or Peter Lynch or whoever these smart investors are, if you look back over time, I think they would be the first ones to say, you can't predict the future. You can't predict these kind of cycles. So diversification can be pretty important.
Okay, yeah, interesting. What do you think about direct versus LP deals? So do you see, like, what is the trend in family offices, how they look at direct deals and how they look at just like allocate capital in different fund managers? Like what trends do you see in family offices? In my opinion, I think they balance both, but maybe like more interested in direct deals in comparison with some institutional LPs like pension funds who might probably invest more in fund managers as LPs versus direct deals. Is it correct, or what do you see on the like deal type selection?
I still come back to that expression: if you've seen one family office, you've seen one family office. I don't think there's any one way that most family offices operate because of the different circumstances. I'll give you an example. I think 7 years ago, the rage seemed to be social investing. And you had a number of family offices where Gen 2 or Gen 3 felt that we want our money to have a purpose when we are allocating it. So they would invest in social causes. For a lot of family offices, that didn't work out too well. And you don't hear quite as much of it. But literally, if you were to just pick out, 3 family offices, you might have one that still did social investing a lot. You might have one that did it some, and you might have one that doesn't do it at all. because they care more about capital return, and they don't look at their money as being something that's going to influence a better mankind. They just want to make a good profit.
Okay, understood. Yeah, let's talk about when family offices split. So you mentioned that like there are Penny Pritzker, JB Pritzker, each of them have their own office now, and probably you mentioned also like 11 siblings of the Pritzker family who all were billionaires. So why did this happen, and does this happen often in family offices, and whether there is a way on how to make some governments, to stop it?
I don't really, I don't have any interaction with two of those family offices that you're talking about, and I can talk broadly speaking about what's been going on with the Pritzker organization as public information, and that's Tom Pritzker's, or the office for Tom Pritzker and his immediate family. But I'm not familiar with the others, and quite frankly, even if I was familiar with what they do, probably would not be appropriate for me to talk about it.
Okay, and do you see some examples of how family offices split in such way, or is it like just one story, and typically family offices are quite stable organizations which survive across many generations? So what, and maybe also, do you think there is a way on how to avoid some problems with family offices splitting into multiple?
I think in general, family office governance, which I think is where you're going with this, is way more important than most people would think. As they say, blood is thicker than water, and what I see, broadly speaking, and I'm not talking necessarily about any family offices that you've mentioned or that I've mentioned, but sometimes the really large wealth isn't not a blessing, but it's a curse in the sense that it's difficult when any family sits down, whether they're ultra high net worth or not. And we've just gone through the holidays here, and I'm sure around the family dinner table, there are some families where everybody can't get enough of each other and they're all in sync and all, and then there's other families where they disagree. So I think that, and this is where the multifamily office comes in versus the single family office. And I think you're going to see more and more multifamily offices. They're going to be institutionalized, and therefore they will be more codified in terms of how they govern themselves. It's kind of like who has a vote and how much is each person's vote worth. And multifamily offices, I think, can take some of the emotion, not for everybody, but can take some of the emotion out of things, because it's just like family businesses. It's very rare to see a family business get to the third generation. Something happens along the way, and there are disagreements within the family. Well, family offices are no different than family businesses in that way, that it's very difficult to get everybody on the same page. And I think it's made even more complicated because, money isn't the answer for for everybody. I mean, I've seen family offices, and not any of the ones that we've been talking about today, but I'm familiar with family offices where they're dealing with addiction problems, with you know, family members who are very jealous of each other, and so on and so forth. And sometimes, family offices are no different than families themselves, in the sense that if you've seen one, you haven't seen them all, and they're all very, very, very different. I do see, both with family offices and family businesses, I've seen some research done, and there's more and more research going on that demonstrates, and I think this is fascinating, it's not so much when the patriarch dies, very often it's when the matriarch dies, because she was the one who kind of set the ground rules, and she was the one who kept everybody in line in terms of their behavior, and it's kind of interesting to see how that works, but there is no one way that always happens. If I was involved with the Weatherhead School of Management at Case Western Reserve in a study that they did on family business succession, and the number of companies that make it to the third generation is single digits percentage-wise.
Yeah.
It's very difficult for family businesses, and just like family offices, to have it passed down from generation to generation. And I think one of the challenges for most family businesses is how can they avoid, it's not what's around when the primary breadwinner makes all this tremendous wealth. It's when that person passes away, because they can't govern from the grave.
Yeah.
It doesn't work very well.
Yeah, totally. So, some of my last questions will be, first of all, many GPs are trying to get on the radar of a family office. And what is one of the best ways you have seen about how someone looking for capital can get in contact and maybe provide some value before asking for money with family offices? But what are some of the best business development best practices for fund managers to connect with family offices?
Great question. There are a number of organizations that have been created over the last several years to give ultra high net worth families the opportunity to share information with each other, to talk about best practices, to connect with advisors, people who've been through these experiences before, who can share their wisdom and their experiences and all. One is called Family Office Exchange, or Fox. Actually, Schwab, Charles Schwab and Company, bought that business, but there's a number of others out there where education and networking are provided, and very often, well, there's another one called Tiger 21, and there's another one called R360, where you have to actually demonstrate, you have to show your balance sheet, and it has to be at least a certain level. And I think that, having the opportunity for if a family has the opportunity to join one of these organizations or networks, and very often it's done in smaller groups. It's very often a forum where information that is exchanged is highly confidential, where families have an opportunity to learn from each other, both the best practices as well as the mistakes that they've made. I think those are going to explode in terms of popularity over the future, because the only way you can learn is from having those kinds of dialogues. But that we're still in the early stages of having those kind of networks, but I think those kinds of things will change over time. People will learn from each other.
And probably this is one of the best ways for GPs also looking for capital to sponsor some of such events or communities and get attention.
Yeah, yes and no. I think it'll be interesting to see whether, if these big corporations start putting it together, but their ulterior motive is to sell some sort of product or service, I don't know that that's going to work very well. I think they're going for one thing and one thing only. We want to learn from other people's mistakes and successes, as opposed to we want to learn more about investing in real estate or early stage venture. Those are two very different things: family governance and family investment philosophy. So, my experience has been that you're either one or the other. It's hard to be both at the same time. Now, having said that, I know that R360 and Tiger 21, a lot of what they do is talk about what they invest in, and they have to do they have to show each other, okay, here's what my family's invested in, and then defend it, and that leads to a conversation about why did you invest in this and why did you invest in that, and dialogue. But the organizations or the collections of people where they really get into the more sensitive issues, the more emotional issues, rather than just the cold hard facts around investment, those are the ones where I think there's a lot of room for improvement. Yeah. And there are consultants out there who are specializing in this, and I think you've talked to some of them on your podcast and there's a growing network of folks who have had experience, good and bad, with family offices and advising them, and can share their wisdom, share their experience. So there's a kind of a cottage industry of consulting to family offices that it's different for a family because there's so much more emotion than, say, a group of pension funds or a group of endowments. It's easy for the endowments and pension funds because usually it's public information what they've invested in. With the families, what they invested in and why did they invest in it tends to be a little bit closer to home and requires a level of trust for people to feel comfortable exchanging that information.
Mm-hmm. Okay. Also,
is that helpful?
Yeah, definitely. Thank you. And probably my last question will be: do you consider some deals, or are you scouting for family offices you are part of, or not? So, are you looking for new deals? What is your thesis? And where is your conviction in terms of type of deals? I definitely understood that GP stakes model in wealth management firms, buying and investing in wealth management firms is one of the interesting strategies for you. But whether you are considering or looking to invest in other types of deals?
And you're talking about what we're doing on the team that invests for the Pritzker organization.
Yeah, and maybe Wellspring, if you also work with them.
Sure. Yes, absolutely. I think that we are always looking for really great management teams. Like I said, that's really important. We want alignment of capital, long dated capital. I think it would be highly unusual and not likely for us to invest with a shorter duration private equity fund, because we'd be at cross purposes, and so forth. But yeah, but the other important thing for us, and I think for most, whether it be private equity funds or venture capital, we don't want to invest in two businesses at the same time that are competing with each other necessarily. That would be kind of the one, non-starter, because it just would create potential conflicts. So we don't want even the appearance of having, conflicts or misalignment along that path. Does that help?
Yeah, I'm trying to understand what are the type of deals are you looking for? Are those just private companies, or and like in different industries, or specializing in financial services, or like might be different types of businesses?
At the Pritzker organization, the team that I'm working with, we are continuing to look for additional investments. Typically, we write checks that are $10 or $20 million on up to $200 million. So in terms of size, we are looking for businesses that don't compete with the existing investments that we already have in Wellspring and Steward Partners. But yes, we're very much still in the market for looking at that. Wellspring is a unique situation because it is a multifamily office. They do some things different. Their fee basis is on a retainer, not on an AUM basis. And Wellspring is certainly looking to grow as an organization. In fact, we think that and one part of our thesis is that, first of all, more and more families need a family office. And so they're looking for something, and starting their own single family office doesn't make a lot of sense for them. And so a multifamily office, for all kinds of reasons, economic as well as just being able to make one phone call and not having to make 20 to get something done. Wellspring, we're definitely looking to grow because we think the market is growing. More people like the idea of a family office. But here's another thing that we think in part of our thesis, which is that there's a lot of single family offices out there where the family is getting to Gen 2 or Gen 3 or more. And the family's saying, do we really want our own family office? Does it make sense for us to hire and fire our own people? Is that the most efficient way to have a family office? Or would it make more sense for us to be part of a multifamily office? And we think there will be single family offices where they'll be dealing with the same succession issue as the RIA industry, and where the single family office may fold into a multifamily office. And that's not really a transaction. That's not, we're buying something. That's just kind of, it makes it easier for the family and more productive for the family.
Mm-hmm. Mm-hmm. Okay, super. Thanks so much, Scott, for this in-depth interview on wealth management, family offices. So I got a lot of insights. Thanks so much for joining.
Max, nice to be with you for this. Thanks for the time. And Happy New Year.
Happy New Year. Yeah.